Hi, and welcome to the Macro Show, where we talk macro and try to make sense of markets. I mean, you want to talk about markets that don't make any sense? Major equity indices were up, right? Bonds up, crude oil up. You wouldn't think that crude oil be up, with Biden looking like he's going to take the presidency. And then the internals, you had, energy stocks were down, financial stocks were down, even utilities looked like they were down, gold mining stock. I mean, I'm your host, Steven Van Metre. Thanks for joining me today. Today on deck, we've got Vol Crush, gridlock in the gridlock in the Senate and House. Love it. Economic data is the install speed. We got to go through that. And of course, we have to talk about bonds. And I know some of you are like, you're going to, wear the crown and declare victory. I don't get excited about small victories. Look, when you're a macro investor and you take a multi-year approach, to different phases of your big picture view, you're always happy when things go your way. But my assumption is they're always going to go against me until, they eventually finally go right. So I'm happy about today. We'll put the crown on. Don't worry, crown's here. Let's get into let's talk about the volatility crush. Because one of the big questions probably today is, why did stocks go up? Are stocks really bullish about a Biden presidency? Probably not. Probably not that bullish at all as it may appear to be. So why did stocks go up today? And the answer to that question is the VIX. We have to go look at the VIX. Now remember, that probably was on Monday and maybe even on Friday, we talked about how the VIX was up around this 36 to 40 level, and I made the comment that it was at a critical juncture, that it either had to go higher or lower. What a phenomenal prediction that was, right? The idea being here that if the VIX were to get much higher here, it was a threatening of a breakout of a repeat of March. The other alternative is it would have to go down, and it would need to go down a lot. You see some of these bigger moves coming off this 36 to 40 level are pretty strong moves down. So what was really going on here, and how did this lead to stock melt-up day? Well, really simple, is hedge funds, portfolio managers, large investors were buying volatility against the election. And as the results came out and it appeared, for whatever reason, whatever managers were worried about went away, they closed out those positions, or they had stops on them that got pushed through. And then all of a sudden you get this major move down in volatility. Was it specific to the equity market, or, as I believe, it was specific to the fact that money managers are like, well, don't need to hedge that risk anymore. And so they were taking a chance here. So some of them were hedged on the long side, and other players were coming in, as we looked at this speculative positioning, were short. And once those longs came off, the shorts ruled the day, volatility drove down, stock prices went up. I mean, that's exactly what we would expect to see on a big move down in vol. Now, the problem with volatility going forward is it's got to go down a lot, because if you look at this move down from March, right, it came down and then it popped up into the danger zone. Then it came down, made a lower low, which was great for volatility, and then came up, got rejected, but now it's getting rejected at a higher level, back up in the 36 to 40. And so vol sellers at this point really need to drive volatility lower, because the trend right now, and this is where I like moving averages. I'm not big on trading moving averages. Well, I'm not a trader, but for that standpoint. But if I were, why do I even have these moving averages on here? They just tell me what the average price is over a period of time. And as I see the 50-day kind of making a nice, bottom here, and then I see the 100-day kind of flattening out, I notice how volatility comes down and is not breaking lower than these levels. Now, it doesn't mean tomorrow or next week it can't. It just tells me that the trend is towards higher volatility. And that is not something the markets are expecting. So I think that was pretty interesting on that. Now, let's get into the economic data, because there's some interesting stuff there. And then we'll come back, talk about gridlock, and then we'll get into everybody's favorite subject of this show is bonds, right? What's going on with bonds? First, the economic data. Excuse me. No, I don't have it. So the air quality here is terrible. So don't think that. All right, Redbook, same store weekly retail sales. This is something I like, Chris Stark likes, and I think one other person we found actually looks at this data, well, other than perhaps David Rosenberg. And this is interesting because you look at that headline number and of 3.2% over last year, and you think, well, that's pretty solid growth. And when you look at it on a chart perspective, and no, I'm going to be very careful about not making this go into full screen mode and repeating Monday's events, is you look at prior to the pandemic, we were running solidly, 5, 6, 7%. I mean, sure, retail sales is volatile. This is a high frequency week to week data point. And right now we're sitting at 3.2. Yeah, it's climbing, but it's still pretty much in a hole. We're not even at the bottom end of the range from before. Not even the bottom end. So I look at that and say, okay, we're hearing people stock up again for the winter. They're concerned. Does retail sales roll over and drop off? Well, we'll talk about that gridlock and stimulus in a little bit. What else is in here that's interesting to me? The durable goods was just a revision, nothing of major importance there. Factory orders right at expectations came in at 1.1, telling us that there's no acceleration in the factory orders on a month-to-month basis. They don't have the year-over-year here, so we can't look at that. Moving down the list of things that I find interesting, we're seeing more of these manufacturing PMIs come in. And what are they telling us? They're coming in, at or slightly above 50, which tells us they're not really growing. The global economy is in stall speed here. So we get to the Eurozone, the composite PMI is going to be manufacturing and services flat, dead flat at 50. Tells us no growth over the prior month. This is not what we're supposed to be seeing in a V-shaped recovery. Look at Great Britain at 52.1 on its composite. Again, almost a very slight, very, very, very slight expansion. I mean, the rate of growth is slowing. How about the producer price index out of Europe on a year-over-year basis? Went from minus 2.6 to minus 2.4. So that means the Eurozone is exporting deflation. Again, all this view that we're going to have this rapid economic growth, V-shaped recovery, inflation is not in the data. We're not seeing it anywhere. Now we'll move on to the U.S. data today. Mortgage applications were up 3.8. Most of it, well, all of it, because the purchase index was down slightly, is in the refinance. And I'm almost wondering, is there a reason people waited this long to refinance? I mean, I'm just kind of curious of, rates are so low. What are they holding out for? Are they waiting, to see if they got their jobs back? I don't know. You'd think they would take advantage of this sooner. Are they, behind on payments? Are they in forbearance a little bit and they're trying to refi to take away a balloon payment? I don't know. I just think it's interesting to me. There's a big jump in refinances this week. And, since I'm not in that industry, I don't really know if there's a driving reason behind it. ADP non-farm employment. Now, normally, if you get 365,000 jobs created by ADP, you should really be screaming about how hot the economy is because, well, it normally doesn't get that high during expansion. But what we're looking at is a recovery from the pandemic, and expectations were 650,000 jobs. Actual was 365. That's not good. I mean, the number is good, but the direction of the number being smaller from last month's 749,000 jobs is not what we wanted to see. October car and truck sales were about flat over last month. Now, exports and imports. This is probably the most interesting thing that I find in the data this week. And why do I care about imports and exports every month? Because it tells me, it's the one economic data point you can look at that tells you for absolute certainty if the economy is growing or not. Because in our interconnected global economy, you want to see exports from countries all around the world going up. And if exports around the world are going up, guess where imports should be going? Right, they should be going up too. And if imports are going up and exports are going up, what does that tell you the consumers are doing? Spending money. And that's what you want to see in the data. So what do we see? Well, we've got some numbers, but this is one of those cases where this is really the easiest way to look at it is in a graph. And we can go down here and change this from bar to the line graph, and you can see that, what are we on, exports? Nowhere near the pandemic levels. They were running 210 billion, and we're at 176. Notice the rate of change. It's slowing down. Now, the Sunday chart show, we talk about momentum. You can see momentum here slowing. It was fast coming off the start. It was like the car sitting at the light, and it turned green, and they slammed on the gas and zoomed off. And they're getting up to speed and slowing, letting off the gas. So momentum is slowing. Let's look at imports, because again, imports, U.S. is the largest importing nation in the world, so maybe there's better news on the import side. And the answer is, whoa, it's almost flat. Still below the pre-pandemic levels, but almost flat. Again, raced off the line. Apparently the speed limit's pretty short on this street for this racer because it's flattening out. So if imports are flattening out, it tells you whatever you're seeing the stock market in terms of economic recovery, what you're seeing in the PMI data, there's something that's not apparent. So you get into today's market data, they had the services PMI showed an expansion. Now let's go look at the services, because you say, okay, well, services are expanding. That's really great. And it is. But when you look at it in context, it's not that great at all, because these are a month over month statistic, and you can see deep destruction in May, and then more destruction in June. And by July, it's still contracting some more. So, we're contracting from a big contraction, from a second big contraction, and it's not until August that it just stops going down. And then in September, it increases, and it increases now again. So this thing is deep in the weeds. It's telling us the U.S. service sector is not healthy. And when we dig into the quote-unquote official ISM data, what you're starting to find is inventory levels are backing up again. And when inventory levels back up, it tells you that there isn't a lot of demand, which obviously is evident in the import and export data. Now, I'm not worried about the crude oil because of the storms going into the Gulf region. There's various shutdowns there, so I'm not worried about that this week. But let's get on to gridlock. So why are we seeing the markets potentially likely to head lower? Where's my arrow down for stocks? There it is. Some of you asked, where are the arrows? Hey, they're still here. I just don't always use them. Why is gridlock not what the market really wants, even though it appears because of the vol crush today it is? Well, let's paint the picture. The Senate is likely to be unchanged, held by the Republicans, right? The House picked up a few Republican seats, but it's still Democrat. That means you've got two opposing views. So if a House passes a bill, the Senate might not. The Senate passes a bill, the House might not. And now you have a potentially, at least at the moment, we have every reason to believe that Joe Biden will be our next president. I may not be, but data says at the moment he will be. So you've got gridlock, meaning you've got a House and a Senate with different majorities, and then you've got a president over here that doesn't have the Senate on his side. So that means that stimulus, this big stimulus that everyone thought was going to be so monstrously inflationary, that it's going to see inflation that Japan and Europe somehow never got from their massive stimulus and easing packages, that we were going to get. Now the belief is there's not going to be anything going on. We'll get a stimulus package, but it may not be what we want. And it means there's going to be gridlock between the House and the Senate in terms of getting legislation passed. Now, I, as a matter of fact, like gridlock. I think that's great for them. That means they have to really work together to get things done. And we know that, well, they're not very good at that. But that means they have to work together. From a rescuing the economy standpoint, a gridlock's not what you want. And that means very likely that, assuming what we know today, all the seats change hands as we believe they might, whatever stimulus is coming early next year is probably not going to be a whole heck of a lot, unless, of course, the current Senate, House, and President Trump can get something crammed through. Maybe they do, maybe they don't. I don't know. But what we do know is the economy is stalling and rolling over. And the best expectations, we have a stimulus in February. Maybe the checks go out in February. Maybe they go out in March. Maybe the checks aren't as big as we thought they were going to be. That is really good for the bond market. Yes, there, someone said, hey, it's not a show unless he puts on the crown. And you got it. It's not a show unless we wear the crown. So let's talk about the bond market and what did we learn last night. And no, it wasn't that I was right or anything like that. That's not what we learned. What we learned is who is controlling this market. And if we zoom in, remember, there's just been persistent selling all the way back since August. And going into the election, just massive selling. And then to overnight trading, you get this move. Let's see if I can show it to you. If you were watching the markets, you saw that yield or bond prices collapse right after close. It's like someone came in with sell. The results start to come in, selling some more, and then all of a sudden, boing, boom, boom, boom. Who was driving all of that move? Well, when it comes into the futures market, you see these rapid moves. They're what we call algos. You hear people in the industry referring to them algos. And what are algos? They're these literally black boxes plugged in with they're given code, free reign to trade whatever it is their programmers gave them. They're given money, maybe opportunities to take out leverage, and they like to play in the futures market, and they're trying to front run whatever is going to happen. And there's not one of them, there's several of them. How many we don't know, and we don't know who has them, but you can see sometimes they're moving against each other. Now, if you're really interested in how these things work and why they've blown up in the past, and there'll probably be a problem with them in the future, there was a hedge fund years ago called Long-Term Capital Management, LTCM. I'm sure there's some free website that's got a story about LTCM on it. Go read about it and how this machine, and it did really good at first. It found opportunities in the market, but to exploit them, it took massive amounts of leverage on micro-sized trades. Now, maybe the people that make these algos have learned from that, because LTCM nearly almost blew up the entire financial system when it came unglued. But looking at the bond market, so we see that these algos may be, someone asked on Twitter, are these algos responsible for that massive standard deviation move? Clearly, they're part of it. How much, we don't know. We don't know who holds these positions, but we could see it last night. And what did we see in the trading today? Now, I was very interested in today's trading, as I told friend of the show, Chris Stark, this morning, who stayed up all last night, for us all last night during the day, for him watching the election and reporting on it, is there was no quantitative easing today. It was not on the schedule, so I really expected massive selling. Now, why is that? Because we're up into this zone where sellers have been. Now, the question is, were all these sellers really these computer algorithms, or were there other sellers? And I don't know. I have no information to say one way or the other, but we're now in a consolidation pattern. Buyers are down here, sellers are up here. This obviously is going to break one way or the higher. Probabilities now are higher since we've just cracked over this downward trend line, meaning upward moves in price and on quite a bit of volume today. We'll start to flush out these sellers. Now, tomorrow is the meeting of a sorcerer JP and his merry band of rats, and we're going to find out what if they're going to make any changes to the QE program. Now, there's no expectations they will, but remember, they've been beating the drum about fiscal. Well, yeah, not going to have a lot of fiscal potentially going forward. So will the Fed use this as an excuse to increase their QE purchases? Will they leave them alone? Now, I'm not worried about the Fed stopping them because, Sorcerer JP has been clear in prior meetings that they would keep QE at a minimum level well into the expansion. Well, we're not well into an expansion at all. So I'm not worried about that. I'm just curious to see what will change. Now, what also is interesting tomorrow is there is no QE tomorrow either. So we're going to have back-to-back days without QE where we get to see how the market behaves. So again, today I was very curious how the market would trade without QE, what will these algos do, and what will they do tonight? Because, we've seen them very active as soon as market closes. They've come in and they've punched prices down in the past, and they've done it around 5:30 in the morning during pre-market. So we'll notice right now there's no activity going on. So very, very curious. Now, I also made a list of things that are pros and cons of bonds right now. And let's do the negative. The negatives are showing there's a 4 standard deviation short in the futures and options market. To me, that's an opportunity. But it just shows you how many people have sold bonds. There's extreme negative sentiment, meaning no one wants to buy these things right now. It's one of the worst sentiment in bonds in history. Now, when you see negative sentiment, and I have a very poor example of it, my chart does have sentiment readings on them, but they're not the best. There are other people that do track sentiment better. And normally when you get, this is this tan line, normally when it gets down at bottom, like it is now, that tells you you're likely on the cusp of an upside move. If you run sentiment on everything, you'll find out here it says there's a bottom and then there was another one. So it's not always telling you what the answer is. It's just telling you there's a possibility. There's been massive issuance of treasury securities, and there's not on the long end of the curve. We saw the release today. Not going to be much reduction going forward. And then foreign investors aren't buying. Some of the pros are the QE. We have the Fed, Sorcerer JP. Primary dealers buying, anticipating a big demand from the public who keep saying they're not going to buy bonds. Yeah. No credit growth. That's not going to change. Certainly not going to change now. Do you think, how do you think consumers are going to react to this outcome of this election? If you were hoping to get stimulus, and now your thoughts are, I might get it, but it's going to be perhaps no time soon and less than I thought. What's going to happen to spending going forward? And of course, lending standards are very tight. We looked at that. That was not the case for the prior election. So really curious again to see how things play out tomorrow, see what the Fed says, and then, the fundamentals for the bond market should get a lot clearer here. And of course, we have the dollar. Don't want to leave without looking. The dollar came down last night. Went below and then back above its 50-day moving average. We really want to see, for my dollar bullish view, for this to really try to stay above the 50-day going over from this point. Now, can it get back down to 93 and I'd still be okay with it? Yes. But at some point in the near term, I'd like to see this thing get over its 100-day moving average and get on with its show. So I'm Steve Van Metre, and speaking of on with this show, be sure to like, because I have cool stick things that my wife made, and subscribe. She does report to that. So if you don't subscribe, she'll tell me you didn't, and nobody wants that. All right, let's get on. I'll see you on Friday. We'll take a look at the credit data and see what the markets, how they're going to respond. Remember, equity markets usually make a false move out of elections. So be curious to see how that plays out. And with that, the content of this video provides educational information only, designed to provide investment or other advice. It is not to be extreme as recognition or solicitation by or selling security, financial or instrument, or to participate in any particular trading strategy. Opinions expressed in this video that do not reflect the view of Alice Financial Advisors Inc. or Steven Van Metre Financial.